Over the past several days, something really interesting has been happening under the surface of the precious metals market. If you just glance at the price charts, you're only getting a tiny piece of the puzzle. What's truly fascinating is the bigger picture, how fast expectations changed, how different players in the market reacted, and how gold and silver moved together. Let's start with silver. It didn't just creep up, it exploded. Based on the data we have, it smashed through price levels that traders have been watching for a long time. This wasn't a gentle rise, it was a powerful surge that made everyone, from trading desks to risk managers to industrial buyers, stop and rethink their strategies. It was a wake-up call, signaling that the old rules might not apply anymore. And then there's gold. It wasn't left behind. Gold also pushed higher, holding onto price levels that just a few months ago most people would have written off as a temporary blip. When you see both gold and silver making these kinds of strong, simultaneous moves, it suggests something bigger is at play. This isn't just about a few speculators trying to make a quick buck. It points to a fundamental shift, a wider repricing of risk and uncertainty in the global economy. Whenever markets move this fast, our first instinct is to find that one single reason. You'll hear analysts pointing to all sorts of things: inflation fears, geopolitical drama, technical breakouts on the charts, or even those mysterious trading algorithms. And sure, all of those things play a part. But the truth is, a sustained move like this rarely comes from a single cause. It's usually a mix of several forces all hitting at the same time, feeding off each other. Instead of trying to pick one hero or villain in this story, it's much more useful to see how these different factors are connected. One of the biggest themes right now is the clash between rising political tensions and changing expectations for monetary policy. Think about it. We're seeing public disagreements between political leaders and the heads of central banks. This isn't totally new, but when these spats become more open and more intense, the market starts to get nervous. People begin to wonder just how stable and independent our most important financial institutions really are. Central banks might try to explain these disputes away with talk of legal procedures or administrative details, but the market reads between the lines. Traders and investors see these conflicts as a sign of deeper instability under the surface. From an investor's point of view, the fine print of a legal argument doesn't matter as much as what it signals about the long-term credibility of our economic policies. When confidence in a central bank's independence starts to fade, big money starts to shift its focus. Investors look beyond the next interest rate decision and start thinking about bigger, more structural risks. And what do? They often start moving into assets that aren't so tied to government decisions, hard assets like gold and silver. If you look back through history, you'll see a clear pattern. Periods where there's a lot of political pressure on central banks often coincide with a spike in demand for precious metals. Now, this doesn't mean history will repeat itself exactly, and it's certainly not a guarantee of future prices. But it gives us crucial context for understanding how large institutions and professional traders tend to react when they feel the ground shifting beneath their feet. Adding another layer to this is the expectation of lower interest rates. If central banks do start cutting rates, it reduces what we call the opportunity cost of holding gold and silver. These metals don't pay you any interest or dividends, so when interest rates are high, you're giving up potential income by holding them. But when rates are low or falling, that downside disappears, making gold and silver look much more attractive in comparison. And we can't forget about the geopolitical landscape. Tensions are high in several key regions around the world. This creates a cloud of uncertainty over everything from global trade routes and energy supplies to diplomatic stability. Even if things don't escalate into a full-blown conflict, this constant background hum of geopolitical stress changes how people manage risk. In times like these, investors and corporations look for a safe harbor. They want assets that are liquid, meaning they can be bought and sold easily. They want assets that are recognized and valued all over the world. And they want assets that are relatively insulated from problems happening in one specific country or region. And which assets fit that description perfectly? You guessed it. Gold has historically been the go-to choice. So, when we put all these pieces together, the recent surge in gold and silver starts to make a lot more sense. It's not just one thing, it's the combined pressure of political uncertainty casting doubt on central banks, the prospect of lower interest rates making non-yielding assets more appealing, and a backdrop of persistent geopolitical risk pushing investors toward safety. It's a complex dance of overlapping forces, all pointing in the same direction. This is why just looking at a price chart can be so misleading. The real story isn't the what, it's the why. It's about understanding the deep currents of fear and opportunity that are moving trillions of dollars around the global financial system. The price of gold and silver isn't just a number, it's a reflection of our collective confidence, or lack thereof, in the future. As we move forward, these are the themes to watch. How will the relationship between governments and central banks evolve? What will happen with interest rates? And will geopolitical tensions ease, or will they continue to simmer? The answers to these questions will likely shape the next chapter for the precious metals market. This isn't just about trading, it's about understanding the very fabric of our global economy. Thanks so much for watching. If you found this breakdown helpful, be sure to hit that like button and subscribe for more deep dives into the markets. I'd love to hear your thoughts in the comments below. See you in the next video. Have you ever wondered why silver's price can be so incredibly volatile? It's a fascinating story, and today we're going to dive deep into what's really driving the silver market right now. It's not just about what you see on the charts. There are powerful forces at play beneath the surface. So, what makes silver so special? Unlike gold, which is primarily seen as a store of value, silver wears two hats. It's a monetary metal, a safe haven when financial markets get rocky. But it's also a critical industrial metal. Think about it. Silver is essential for solar panels, electric vehicles, 5G technology, and countless other modern applications. This dual role is a recipe for volatility. When investors and industries are both buying, the price can explode faster than anyone expects. And when they both pull back, it can drop just as dramatically. It's this tug of war between investment and industry that makes silver one of the most exciting commodities to watch. Now, let's talk about a major game changer: government policy. Recently, the United States officially designated silver as a critical mineral. This is huge. It's a formal recognition of silver's strategic importance to national security and the economy. Even if new trade policies or tariffs aren't slapped on tomorrow, this designation sends a powerful signal to the entire market. It tells manufacturers, investors, and even other countries that securing a stable supply of silver is now a top priority. Markets are forward-looking. They don't just react to policies that are already in place. They react to the hint to us of future policy. When a government says a material is strategically important, what do you think happens? Companies that rely on that material start to get nervous about their supply chains. They begin to adjust their strategies. They might start looking for new suppliers to diversify their sources. They might build up larger stockpiles, creating a buffer for any future disruptions. Or they might try to lock in long-term contracts to guarantee their supply at a predictable price. These changes don't always show up in the economic reports right away. But they create a slow, steady, and powerful undercurrent of demand that can build over months and even years. Of course, not everyone agrees on what's driving the price. Some analysts will point to the recent price spikes and say, that's just speculation. They argue that it's not a fundamental shift in demand, but rather a crowded trade where too many people jumped on the bandwagon, creating a temporary bubble. And to be fair, history is filled with examples of both scenarios, speculative frenzies and true fundamental shifts. That's why it's always smart to approach the market with a healthy dose of caution. A breakout could be the real deal, or it could be a trap. Understanding the difference is key. This brings us to a really important and growing debate, the difference between the paper market and the physical market. When most people talk about the price of silver, they're referring to the price on futures exchanges like the COMEX. These are paper markets where contracts for silver are traded. They provide liquidity and help the world figure out what the price should be. But there's a big difference between trading a contract on a screen and actually taking delivery of the physical metal. Lately, we've been hearing more and more buzz about a shift. More participants, from large institutions to individual investors, are choosing to take physical delivery of their silver instead of just rolling their paper contracts forward. Why does this matter? Well, if this trend continues, it could seriously tighten the available supply of physical silver. Imagine a warehouse that is supposed to have 1 million ounces of silver backing up all the paper contracts. If everyone starts showing up at the door asking for their metal, that warehouse is going to empty out pretty quickly. This could happen even if the total amount of silver being mined doesn't change. However, we need to be careful when we interpret this data. An increase in physical delivery doesn't always mean a bank run is happening. Sometimes it's just routine business. A company might be taking delivery as part of its normal hedging strategy, or simply managing its inventory. There can also be logistical or regulatory reasons for these shifts. But, and this is the important part, when you see a wide range of different participants, not just the usual suspects, all starting to demand physical metal, that's a signal you really need to pay attention to. It suggests a growing lack of trust in the paper system and a strong desire to hold the real asset. This focus on physical demand is completely reframing the conversation around silver. We're moving away from abstract debates about futures market positioning and getting down to brass tacks. The real questions are becoming, who actually needs this metal? What are they using it for? And how urgently do they need it? Let's think about the industrial users for a moment. For a company making solar panels, silver is a tiny fraction of the total cost, but it's absolutely essential. They can't make a solar panel without it. So are they going to stop production because the price of silver doubles? Probably not. They're less sensitive to short-term price swings. Their consistent, unwavering demand can act as a stabilizing force for the market. But in certain situations, if they all panic about future supply and start hoarding at the same time, they could actually destabilize the market and cause prices to skyrocket. Finally, we can't ignore the power of psychology and technical analysis. There are certain price levels that everyone in the market watches. When silver's price breaks through one of these major resistance levels, it can trigger a cascade of secondary effects. Traders who were betting on the price going down, the short sellers, are forced to buy back their positions to cut their losses, which pushes the price up even further. This upward movement attracts momentum traders who jump in to ride the wave. At the same time, complex options markets react, with dealers having to buy silver to hedge their own positions. It can create a powerful feedback loop where buying begets more buying, leading to those explosive price moves we talked about earlier. So, as you can see, the silver market is a complex ecosystem. It's a blend of industrial demand, investment flows, government policy, and market psychology. It's the tension between the paper and physical markets, and the push and pull between long-term fundamentals and short-term speculation. Understanding all these different layers is crucial to navigating its future. It's a story that's still unfolding, and it's one we'll be watching very closely. Thanks so much for joining me on this deep dive into the world of silver. If you found this analysis helpful and want to stay updated on market trends, make sure to hit that like button and subscribe to the channel. We'd love to have you as part of our community. See you in the next video. Have you ever wondered what really drives the price of silver? It's not just one thing. It's a complex dance of money flows, market psychology, and real-world supply and demand. Let's break it down. First, let's talk about the big money flows. These don't create demand out of thin air. But once silver's price hits a certain key level, they can pour gasoline on the fire, accelerating the price movement. But here's the crucial question. Will the new price stick? This is all about durability. A price breakout that happens all on its own often falls back down once the initial excitement fades and market positioning goes back to normal. However, when a breakout happens at the same time as major global events, like big shifts in government policy, economic uncertainty, or worries about supply shortages, things can get really interesting. The price action can be different, but you can still expect a wild, volatile ride. Pullbacks are a totally normal part of this process. Think of it like the market testing the ground, trying to find a new stable price level. But make no mistake, risk is always part of the game. Silver has a long history of sharp, sometimes sudden price drops. That volatility we just talked about, it cuts both ways. And if you're using leverage, it can magnify your gains, but it can also magnify your losses just as easily. Even when all the signs seem positive, a rapid reversal is always possible, especially if investor sentiment suddenly changes or another asset becomes more attractive. Now let's add another layer of complexity. The supply side. A lot of silver isn't mined on its own. It's a byproduct of mining for other metals like copper, lead, and zinc. This means that even if the price of silver skyrockets, miners can't just flip a switch and produce more. The supply is relatively inelastic. So when you have strong demand hitting a supply that can't easily increase, it can send short-term prices soaring. On top of that, you have real-world logistical challenges. Things like transportation bottlenecks or not enough warehouse space can create delays in getting the physical silver to where it's needed, further impacting the balance between supply and demand. Human behavior also plays a massive role. Investors have long memories. They remember past silver price spikes and those long periods where the price did nothing. These memories shape how they react to today's market. When the price breaks through a key psychological barrier, like its recent moves into the low $90 range, it can set off a chain reaction. Algorithmic trading programs kick in. Investors who bet against silver are forced to buy back their positions in a short squeeze, and momentum traders jump on the bandwagon, all pushing the price higher. But for these gains to last, you need more than just technical momentum. You need real, underlying demand and structural support to keep things propped up. The structure of the futures market itself is another key piece of the puzzle. Things like options contracts and margin accounts can definitely amplify price swings, but they can also act like pressure release valves. When volatility spikes, traders might be forced to adjust their positions, which can exaggerate short-term price movements. But here's the key. If the underlying demand for silver is still strong, these forced adjustments often end up being accelerators for the price trend, not the cause of a reversal. Ultimately, what we're seeing in the silver market right now isn't about one single catalyst. It's a convergence of many different structural pressures, all coming together at once. One of the most critical signals to watch is delivery behavior. When investors and industrial users start prioritizing getting their hands on physical silver instead of just holding a paper contract, it tightens the near-term supply. This makes the market extremely sensitive to any changes in either industrial or investment demand. You have some players making strategic, long-term moves based on these potential shifts, while others are just reacting tactically to the short-term price action. This mix of long-term strategy and short-term reaction is what's feeding the current volatility. It also shows why it's so important to analyze both the physical market and the paper, or futures, market together. They tell two sides of the same story. So, to put it all together, silver's current state is being shaped by a perfect storm of interconnected forces. We have political uncertainty around the globe, shifting expectations about monetary policy and interest rates and ongoing geopolitical risks. We have strong industrial demand, especially from green technologies, and new government policies focusing on critical minerals. And we have the behavior in the physical delivery market signaling a preference for tangible assets. Understanding how all these pieces interact is absolutely essential if you want to interpret silver's price behavior, assess the real balance of supply and demand, and anticipate how the market will react to future events. It's a fascinating, dynamic, and ever-evolving story. Thanks so much for watching. If you found this breakdown helpful, be sure to hit that like button and subscribe for more deep dives into the markets. See you next time.